There are plenty of angry bears out there, and for good reason. The economic data is really not great, but the performance of the market has been something else. What's your takeaway?
Well, let's put everything in a little bit of context today. We have $18 trillion worth of debt that yields zero. So everyone is seeking yield, and of course this has been an extraordinary rally in the bond market. So that's the backdrop. When we take a look at equities and everyone looks at the indices, they sit there and say, well, the indices are incredibly high and probably overvalued. But they have to look into what the indices are, right? You've got market leaders that have been beneficiaries, especially in technology, as a result of the pandemic. Just what we're doing today, the substitution effect is alive and well. And secondly, and I haven't heard anything about this morning, when we really look at the consumer data, it's been remarkably resilient in those areas where COVID has not been a big deal. So if you take out travel, you take out retail, you take out hotels, you take out educational institutions, and you take out small healthcare providers, about 11 or 12% of the economy, the rest of the economy has been remarkably resilient. For example, you would have thought, taking a look at the data in Florida, Texas, California, and South Carolina, that people would have started to travel less, that they would actually have started to go back home and not spend. And the exact opposite has been the case. The American consumer and the European consumer have continued to buy in spite of the fact that the virus is all around us. And that has been the surprising event for me in terms of the economy as we look out.
So, David, August is going to be really interesting then, because the enhanced unemployment benefits have expired. Do you think that's going to be an important force to shape the August data, or will it be more about what you've just discussed?
I think August can be mild, Jonathan, and if we were to see that the Congress did not pass anything, I think then you can have a further headwind from all of this. We went back and looked at the last 40 years of sort of these congressional standoffs, and what we found is that there's always a compromise. At least historically, there's always been a compromise. We've never been in exactly this situation. So if we get a compromise in September, then I don't think we have anything to worry about in August. If we got no action on the part of Congress, that would be a pretty big deal.
And David, this seems to be what the market is betting on right now, that there will be reason eventually that will set in Washington, D.C. How much has, though, the fiscal support in Washington, D.C. backstopped the recovery? I mean, part of the reason, first of all, I'm not an angry bear, John, just to let you know. I'm not an angry bear. I'm just struggling to understand the dire economic...
For the people on radio who can't see David Balin's face right now. I mean, David doesn't believe you, but carry on.
Well, no, it's just that there's a lack of understanding here. The idea that you could have such a high unemployment rate, that you could have bankruptcies at a record pace and have such steady data. David, why is there this dissonance here?
So I think we have to break up the points a little bit. First of all, the unemployment rate was expected to be far higher than it is now. At one point, people were talking about 20% unemployment rates, and now we're at 10% and coming down. And as I mentioned, that's largely concentrated. And the other thing that we have to look at is really what happened to earnings. They were better than expected as well. And different parts of the market were really hit differently. The market is efficiently pricing the winners and the losers at the moment. All we have to do is look out 6 months and ask ourselves this question. What will happen when a good vaccine, one that really works, not the Russian version, but a real version, actually comes out with proper testing, and we know that there's going to be an effective treatment like there is for the flu for this pandemic? I think that's going to change everyone's mindset. And Lisa, you said something just in the last segment prior to the top of the hour that's very important. You talked about the velocity of money. And that velocity takes time, meaning that we've never had this kind of spending before. $10 to $12 trillion globally of liquidity, not just what's happening in the U.S., not just monetary but fiscal. That's going to have a tailwind to the market, and a tailwind that's going to be very stimulative in 21 and 22, as we've written to all of our clients in the last several weeks. It's a very important tailwind, and it will be the velocity of money going forward. So if you combine those two factors, this market for equities is not insane. And Jonathan, you also said something that I wanted to touch upon. You talked about the fact that return expectations in the future should be modest because of how high the market is, and you're exactly right. But there are parts of the market that are going to roar ahead in the future, and parts like technology that are going to move very modestly ahead because they're so fully priced. They've discounted so much of the future already today.
There was a lot in there. Let's unpack a little bit of it. When it comes to velocity of money, are you predicting that inflation is going to pick up?
It could pick up a very small amount next year, the year after. We're not making a major call on inflation. What we are making a major call in is a recovery in economies that's greater than people expect. So, for example, in Europe, right, where everyone is sort of very tentative, we think next year could be a 4% GDP year, and we haven't had one of those in a decade, right? And we also feel like the Chinese economy, and especially the Pan-Asian economies, can do better than expected because of the de minimis impact on those economies by the virus, and the fact that exports are going to pick up much more, than I think is projected in 2021.
I hear a long on banks. I just heard a long on industrials. Is that right, David?
Yeah, well, I do like a long on banks. Again, to Lisa's earlier point, I think we're going to see the yield curve steepen for a combination of the fact that there is an enormous amount of issuance and because the economy is going to pick up, and that's going to change inflation expectations slightly going forward. And if you take a look at dividend yields for banks, you would think that they're very attractive today, and they'll stay attractive, and of course then there'll be the appreciation if that's right. Plus, there's been limited credit losses because of the programs in the United States in particular, so we like that. And in terms of industrials, the larger ones, Jonathan, are pretty fully priced now, but a lot of the small and medium caps are not fully priced. They're 20 to 30% lower. They've had 70% negative earnings surprises in the second quarter, which is pretty abysmal. And so there's a fair amount of room of snapback in the small and medium-sized industrial companies in the U.S. and in Europe.
Just before we let you go, the regional bias, you mentioned Europe a couple of times there. We had this conversation with David Riley of Blue Bay Asset Management about the European trade, just facing some challenges in the last couple of days. David, what is the regional bias for you?
Yeah, I mean, to me, the last couple of days are creating a little bit of that buying opportunity. I think we have to see real data. And the market, because of all of the news flow, of course, is very focused on what's happening today, We're looking out, for Citi Private Bank at 6 to 12 months, right, in terms of our view, and then 12 to 18 months for investing. So when we think about that, we like Europe on that basis, especially industrials that have dividends associated with them. We like some of the mortgage REITs here as a substitute for some of the concern that Lisa has for junk bonds, and we like Latin America as a snapback play, specifically Mexico, as a result of when the U.S. is fully operational. Imports and exports from Mexico will really go much higher. We don't like that as a long-term play. So there's a lot for investors to do. And I think that it's moving their portfolios away from technology, where they've had this extraordinary gain, and into some of these other sectors that will allow them to make alpha, extra profits over the course of the next 12 to 18 months.
I like a lot of stuff Lisa doesn't like either. David, great to catch up with you.
David, I don't know why you're trying to get me in trouble, but thank you.
Citi Private Bank, we appreciate your time.
That's what I say.
Thank you, David. Thank you very much. Do you like that, Lisa? 2 guests in a row. It's not bad.
Someone on Twitter putting out a picture of me as an angry bear.
As an angry bear?
Listen, I'm not an angry bear. I just think it's fair to be skeptical and try to understand. Look, I'm not alone. If you take a look at how much money the banks have set aside for bad loans, why is that happening if you're getting, an economy that otherwise is getting back on track?
Lisa, I'm joking. I totally agree. There are so many things that don't make sense right now, but I'm going to lose little sleep for the distressed debt investor that just didn't get their 08, 09. I don't care about that. I do not care about that one bit. What I think is really interesting, just from a system sort of perspective for capitalism, what this means about money that should flow away from bad companies and should flow towards good ones, what this means for potential growth in the future as well. Lisa, I think those are all really valid points. When we are facing what we're facing right now and rates across the board are where they are, I think you're right to question it.
Yeah, and the zombification of corporate America, but frankly, corporations around the world.
Coming up on the program, Greg Valliere of AGF Investments will get his view on the stuff Lisa doesn't like. Right here from New York City, this is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. President Trump hasn't yet delivered the deal of the century he promised in the Middle East. Still, he can claim a foreign policy victory after Israel and the United Arab Emirates agreed to move towards normalizing relations. Even Democratic presidential candidate Joe Biden called it a historic step. There's a roadblock that's preventing Congress from passing a new coronavirus relief plan. Democrats demand the package include $1 trillion in aid to struggling state and local governments. But Republicans argue the money would go to bail out poorly managed states. Nothing's likely to happen the next 2 weeks. That's when the two parties hold their conventions. And President Trump clashed with Joe Biden over masks. The Democratic presidential candidate said every governor should require masks for the next 3 months. He said that would save more than 40,000 lives. President Trump rejected Biden's approach. He said, quote, "We want to have a certain freedom. That's what we're about." When it comes to personal finances, Donald Trump isn't better off than he was 4 years ago. According to the Bloomberg Billionaires Index, the president's net worth has declined $300 million in the past year to $2.7 billion. That's the biggest drop since Bloomberg began tracking his wealth back in 2015. It started with a decrease in income across the Trump organization's office buildings. The pandemic made things worse. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed, but the good news is that it is continuing, and it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio. Around about 12 minutes away from the Data in America, U.S. retail sales coming up, almost said from the market open. That comes an hour later. Here's the price action. Equity futures down 2 on the S&P 500. I'll get it together. We're down 0.1%. In the bond market, your yield 0.7% is your yield on a 10-year. In the FX market, euro dollar 118.15. That's the story in the market. Here's the story of global politics. Hong Kong media tycoon Jimmy Lai arrested last week under the city's national security law, fueling concerns about how quickly the Chinese Communist Party is tightening its grip. Lai speaking to Bloomberg about the arrest and the outpouring of support he's received.
The national security law is very vague and general, so is the charges. I've never given 1 cent or 1 buy to the movement. And nobody has given us any money except moral support. That's all I can tell you. The national security law will be low profile in its execution, but they have to show the teeth of enacting it on some people to show to the Hong Kong people that anytime we will enact it, it's very negative to the, to the business community here and overseas. We can't confront, the CCP. We can keep our spirit, but we have no other power than moral power.
Jimmy Lai there of Next Global Media. Lisa, pretty clear his thoughts on things, though conceding at the end, we have our spirit, and that's about it.
Yeah, it's a big uncertainty, and one of his main points in this interview was it was surprising that Beijing came after him this quickly after enacting the national security law, that they were sending a signal that was surprising to some, as they had expected Beijing to hold off and wait for some of the sentiment to die down.
Joining us now is Greg Valliere, AGF Investments Chief U.S. Policy Strategist. Greg, the two sides, the United States and China, will be having a call, virtually of course, over the weekend. I just wonder how Hong Kong is a part of those conversations over the trade agreement, Greg. How do you think this is going to come up?
Well, the deep freeze continues, John. I think that relations will stay very hostile. Ironically, this weekend's talks are on trade, which it continues. We got phase 1 of a trade deal, and I think that's worked fairly well. But the detention of dissidents, the hacking, all of the things the Chinese have done, I think will increase the likelihood of more sanctions.
What do you think the U.S.'s goal out of this weekend is going to be?
I think the goal is to show that U.S. farmers are still buying soybeans. I mean, to be cynical, I think the president wants to show that that part of the trade deal is working. But beyond that, I think a real crisis looms on WeChat more than TikTok.
Okay, crisis for who?
For both countries. WeChat is so widely used by the Chinese. I think if we impose sanctions, there will be counter-sanctions. I could worry about Google and Apple. I think that these recriminations will certainly continue through the U.S. election.
Isn't this the problem, though, Greg? That we talk a lot about reciprocity, but when it comes to Chinese tech, we're in this position where you can't shut WeChat down, but you can tell Facebook they can't be in China. How are we going to sort these problems out if this is the approach?
Well, Donald Trump famously says, I'm a tariff guy, and I think that he is prepared to use that again. He did it with Canada recently. Western Europe still faces threats, and I think China as well could get more tariffs.
But this is the issue, isn't it, Greg? That the approach of this administration, and Lisa was talking about this a little bit earlier, how do we change the Chinese Communist Party behavior? That's essentially the question that's been asked down in Washington, D.C. for the last 20 years or so. And what I see at the moment is every time the administration tries to do something, the C-suite in America gets on the phone to the administration and says, don't do this, because of the commercial power that China as an economy still has. And Greg, I just wonder if this president right now, President Donald Trump, is not in the White House for a second term. Let's say we get a new administration.
Yep.
Is there a better way of dealing with this?
Well, there'd be two things, carrots and sticks. The carrots would be for Joe Biden, if he wins, to hint that he could rejoin the Trans-Pacific Partnership. I think that would be constructive. The stick is from Congress, which could pass legislation that could reward companies to bring jobs back to the U.S.
Is it in the U.S.'s interest to link some of these tech concerns with the trade issues? In other words, that's what China is trying to do, and the U.S. has been pushing back and trying to keep these separate. Clearly, China is not going to allow that to happen. Could the U.S. potentially benefit from linking these as well?
Well, we could potentially, but I think right now there's a bipartisan view in Washington that the Chinese have been outrageous. Their lack of transparency on the virus, their hacking into all of our companies, their treatment of dissidents. I think that right now the mood in this town is quite hostile toward China.
On both sides, as you point out, Greg, both sides can't agree on a fiscal package, though, so let's wrap things up there.
Yep.
When do you see this happening, Greg? We came into August and everyone said, deal's got to happen, end of July, that's the deadline, all this stuff expires, really important things, really important policy. And here we are, the middle of August. Are we looking at September now?
Yeah, I'm still undaunted. I still think there's going to be a deal at some point. Both sides need it. Pelosi needs to show that she's not just cynical while people are suffering. Trump needs a deal because the economy could get a little weaker in the fall if we don't get one. So I think it's incumbent upon both sides to get one, but it's still probably 2 or 3 weeks away.
What would change your mind, Greg? What would you need to see? What would be the big red flag that you sat there and thought, okay, maybe this isn't happening?
Well, I think the big game changer would be signs of economic weakening. We get retail sales in a few minutes. I think that would be a big deal. I still think that something around $1.5 trillion is still quite doable.
Greg Valier, great to catch up with you. Greg, down in Washington, D.C. on the latest, joining us from AGF Investments. Lisa, we keep hearing it. It'll happen. It'll be around $1.5 trillion, but the date keeps getting pushed back. It's gone from the start of the month to maybe the middle of the month, and now to the start of September and maybe the middle of September.
There was a study done by the University of Chicago in 538, polling economists and saying, what do you think the consequences will be if there is no deal struck by at least September 1st, right? We're coming up on that. And they said that the likelihood was that we'd see an increase in food insecurity. We'd see an increase even in joblessness because a lack of consumer spending would slow the economy and hamper any kind of upswing in job rates. I'm struggling to see where we're seeing this priced in. How are people responding to this? It's not just a deal. We haven't gotten it, period.
Well, we're not seeing it right now at the aggregate level in the economic data or in the equity market. And Lisa, I know this sounds cynical, but I think it's true. When you look at the equity market right now and compare and contrast the situation we're in right now compared to where we were in March, this happens in history again and again in economic crises, and for that matter, foreign policies ones as well. When you exit the immediate crisis right in front of your face and you're coming out the other side, the collective will fades.
Yeah.
That's what we're seeing playing out down in Washington.
And to be fair, I mean, even companies have been surprised in their earnings reports at how strong the recovery has been for them. So perhaps the economy is doing better than people are expecting.
We'll see. In about 5 minutes' time, we get U.S. retail sales data. Looking forward to covering that. We will bring you Michael McKee on the data, and then afterwards, Michael Gapon of Barclays. All eyes on D.C. The economic data 5 minutes away. Your price action shaping up as follows. Equity futures down 2. We're negative just 0.1% on the S&P 500. In the bond market, 5 days of losses on treasuries. Yields today, we just start to stabilize coming into Friday. We're down a basis point to 0.7%. A 5-day losing streak into Friday. What happens a little bit later after that retail sales print? That's next on Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en unas
en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas.
Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración.
Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo.
Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
US retail sales incoming from New York City. Good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. Your economic data about to drop across the Bloomberg terminal. With that data, here's Michael McKee.
All right, John, we are looking right now for the retail sales numbers, which everybody, of course, is interested in to see what happened. Census Bureau a little slower in getting them out, but we are now seeing that retail sales are coming in worse than expected, up 1.2% in the month of July. The forecast was for a 2.1% gain. Ex-autos, 1.9%. That's a little bit better than expected. 1.3% was what was forecast. Remember, we were in the 7% range for the month of June. The control group, now this is the one that economists watch because it basically sets out what goes into GDP. Retail sales control comes in better than expected, 1.4% up on the month of July. That compares with an 0.8% forecast for that and a 5.6% increase in the month of June. So it is not as good, certainly, during the month of July as it was in June. Things have slowed down. We can also mention this. This is going to be interesting, and this is obviously distorted by who's been at work and who's been on and off payrolls. Productivity is out, up 7.3% in the second quarter. The unit labor costs up 12.2%. Obviously, people who had at this point, the lower paid people off payroll, so that increased the cost to businesses. Taking a quick look here at what went up and what went down during the month, we see that motor vehicles and parts dealers were down 1.2%, which is a kind of a contrast with what was expected because the unit sales had come in strong. Furniture and furniture stores were flat on the month. Electronics and appliance stores, 22.9% increase on the month. Building materials down 2.9%. Gasoline stations up 6.2%. Gas prices had risen during the month. And remember, retail sales are calculated on a dollar volume basis. Sporting goods down 5%. 5%. Food services and drinking places, this is an interesting one. It's up 5%. A lot of people thought we'd see a decline in food services and drinking places because so many of them had to reclose again once the governors started shutting down in response to increased COVID. The only thing I can tell you there, guys, is that this survey is the advance survey for the month, and it is pretty much calculated through the first half of July. So next month we'll get some revisions, and we hope at that point we'll see whether we really did see an effect from that COVID reappearance in so many states.
Mike, let me just whip through the price action about 57 minutes away from the opening bell. Equity futures just about turning positive on the S&P 500. As the retail sales numbers came out, they came out just drip feeding them. And then the retail sales control group came out with that positive surprise, and things turned around a little bit again. So Treasury yields came in. Now they're back up, down about a basis point in the session. That's your net position now, 0.71% is your yield on a 10-year. In foreign exchange, 118.19 is where euro-dollar trades. Mike, I just wonder what the more important story is for you as an economist right now. Is it the number relative to expectations, or just the clear deceleration over the last couple of months?
Well, I think I'd offer a third category, and that's with revisions to June. June, all of the categories in retail sales pretty much revised higher for June. It came in at 7.5%. It's been revised to 8.4%, and that control group, which was 5.6%, increased to 6%. So over a 2-month period, we did see a significant rise in retail sales. Of course, we were down 14.7% in the month of April, so making up some of that ground, and it does suggest that Americans are willing to spend when they get the chance.
Mike McKee, great to see you, as always. That's the story in the data, the story of the market, just about positive on the S&P 500. Joining us now is Michael Gapen, Barclays chief U.S. economist. Michael, great to catch up with you, sir. Are we still working our way through these mechanical distortions going from shut down to reopen?
We are, but I think that's a little bit in the rearview mirror now. I think Mike McKee's point at the end there is what was important. The downside miss in July is most likely related to those upward revisions in June. So on net, my guess is when we look at the data, the level of retail sales in July will likely be about where we were expecting. So things have slowed, but that, in my view, that was to be expected. So 2 months ago, we had about an 18% rise in retail sales, about 8% last month. Let's call it somewhere between 1% and 2% this month. I think that's consistent with an initial snapback and ongoing recovery. So I think most of that lights on, the economies are back open, is fading out of the data right now. I think the July data in total suggests the economy still has momentum. The open question, as you've been debating this morning, is whether we're going to have enough momentum to carry that through into September and October.
Do you have a sense, based on the more granular data that you look at, of how much of this spending has been driven or supported by the fiscal support that we have seen so far?
I think the government transfer payments have been crucial in underpinning this virtuous cycle of spending leading to an increase in production, leading to a pickup in employment, and that virtuous cycle. If you look at personal income in June, so we're lagging here a month, but that's all the data we have. Personal income in June is about 19.9 trillion. That's about 3 to 4 to 5% above where we were in February. If you subtract out the unemployment payments and the pandemic assistance, the rebate checks that were sent to households, income is down more like 8%. So I think it's been completely key in replacing lost wage and salary income, and in effect, keeping income for households consistent with full employment. So if we don't get those kinds of payments going forward and we don't get a phase 4, income has to adjust to an economy with 10 to 11% unemployment. And I think that's the debate we're having. When does phase 4 come? Does it come? Will it be sufficient to keep this virtuous cycle going?
Yeah, and when will this virtuous cycle be able to sustain itself without ongoing fiscal support? I mean, there's a sort of philosophical argument. Should we be paying every American to buy a car, right? Should we be paying everyone to go out to eat every night because that supports the economy? Some people might say, look, if that injects enough money into the economy and it gets new jobs, maybe it's worth it. But at what point can we say, look, this will sustain itself, people will go out and get a job?
So that the answer to that is subjective. I certainly think that the recession was induced by shutdown orders. So I think it's reasonable to say we should kind of buttress household income on the other side as a result. Is 2 to 3 months worth of support enough? My view would be leaving the economy with a 10 to 11% unemployment rate is probably not strong enough, and several more months worth of benefits would be helpful, because I think what you would want to do in essence is underpin 2 to 3 to 4 more months of about 750 to 1.5 million jobs per month. Then I think you could take your foot off and say, look, I think we've done enough to get this recovery on a self-sustaining basis. Let's see where we are from here. Backing off when the unemployment rate is 10% or a touch higher, to me, seems more risky than it needs to be.
Michael, how much of that money that was distributed in the last several months, enhanced unemployment benefits, the fiscal transfers, the direct aid, the direct checks to Americans, how much of that has been spent and how much of it is sitting in bank accounts saved? Do you know? Can we figure that out somehow?
We can back out rough estimates. I mean, the savings rate did go as high as about 33%. It's coming back down. I think we're probably 1 to 2 months away, about a month away from having spent nearly all of the pandemic assistance, whether it's the rebate checks or the unemployment insurance. So I think we're kind of reaching the last 30 to 45 days of that. So I think we've spent a lot of it, but not all of it. I think there's still some accumulated savings there that could support spending as we move into August. I think as you push into September, I think it's hard to argue that's going to be the case.
There's clear pain in this economy, Michael. You and I and all of us can agree on that. I'm just trying to work out when this starts to show up in the headline data. Do you expect the test to be in August then, or is it in September? Because the enhanced unemployment benefits, as we know, have expired. And I'm just trying to work out whether August is that moment where we have that test of going cold turkey somewhat, or whether it's September.
I would, from what I know this morning, I would say it's probably more September than it is August. At least the labor market data so far in August seem to suggest that momentum is continuing. And I think there's a difference here between whether things are leveling out or turning for the worse. So I would put a little more emphasis into September data versus August, but obviously we will see.
Going forward, what's your biggest concern in terms of the data that you're watching that could indicate a further slowdown than perhaps people are expecting?
Well, I think I don't think this answer is going to surprise you, but it is employment. And so if households are spending enough, production will stay elevated and employment will continue. The rehiring will continue apace. But if we get a break in that rehiring rate, then I think all bets are off in that regard. We pay, a lot of attention to the high frequency data on mobility, as well as everything we're seeing in the labor market data, because that's where household confidence and household spending ultimately will come. Yes, spending is being supported by government payments today, but it's got to be more organic through employment growth going forward. So I'll also be very interested in the University of Michigan consumer sentiment number later this morning. Will it show a third straight monthly decline off of the levels we saw a few months ago? That could be a sign that households are feeling a little more shaky. If that number holds up, it may give you the view that labor markets are better than we are characterizing them at present, and sliding away from government benefit assistance may not be as risky as we think. So I do think that's an important number to look at later this morning.
Michael, just before we let you go, Lisa would like to know what you think of high-yield credit in the United States.
Seriously, really?
If you've got anything to say.
Do you like triple C's?
I like triple C's. I'm not an angry bear at this point. I do think that the economy is showing some good resiliency despite the high numbers of COVID cases. I think that can continue, but I think it needs some additional federal support to do that.
I love the response of a serious economist. Michael Gayfin of Barclays. It's good to see you, sir, as always. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene will be back with us on Monday. Coming up on the Open, Savita Subramanian, Bank of America Securities, joining us around the opening bell in the next hour on Bloomberg TV, live on Bloomberg TV and radio. This is Bloomberg Surveillance, with an equity market unchanged on the S&P 500, down around about a point as we count you down to the opening bell, with a record high still in sight. This is Bloomberg.
With the First World News, I'm Rishika Gupta. In the coming weeks, President Trump plans a White House signing ceremony to celebrate his biggest foreign policy achievement. Israel and the United Arab Emirates reached a landmark agreement that was announced by the president. The two countries agreed to normalize relations. In return, Israel promised to hold off annexing West Bank territory. The UAE will become only the third Arab country to have diplomatic ties with Israel. Even with a vaccine, the battle against the coronavirus is likely to be a challenge for years to come. That's according to pharmaceutical and public health experts at an event hosted by Bloomberg Prognosis. They say a vaccine will provide some measure of protection. Still, they expect the virus to flare up from time to time, just like the flu. Yale University said it is dismayed that the Justice Department ruled that it discriminates against Asian Americans and whites in admissions. The college says authorities made their determination before allowing Yale to provide all the information they requested. The government is threatening to sue Yale unless it changes its process immediately. And the maker of the popular online game Fortnite is suing Apple and Google. The two companies moved their game from their app stores. The disagreement stems from an Apple policy that most apps must offer billing through Apple and pay the company 30% of the revenue. Yesterday, Fortnite maker Epic Games offered customers a way to circumvent the fees. And Amazon will be facing a new foe in Washington. More than a dozen trade groups are forming a coalition to force Amazon and other e-commerce companies to take stronger measures against counterfeit goods sold on their platforms. The Buy Safe America coalition includes industry groups which represent Walmart and Best Buy, amongst others. The goal is to get Congress to pass legislation. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
You have to look at the technicals, not just the fundamentals, because right now the fundamentals are not what is driving the market.
It was absolutely brilliant to catch up with Double Line's Monica Erickson in the last 24 hours. Catch that interview on Bloomberg.com and on the Bloomberg terminal as well. Live on Bloomberg TV and radio. Coming up a little bit later on Bloomberg TV. Looking forward to a conversation with Mohamed Al-Arian, Bloomberg opinion columnist and Allianz's chief economic advisor. Lisa, that coming up in about 22 minutes' time.
I can't wait. Will you ask him whether he's an angry bear right now?
Of course
please?
I will.
Thank you. I appreciate
We will talk
that.
about you, but we always do.
Well,
First question to Mohamed, literally. The first one I asked.
I can't wait to hear from Mohamed, and I'm sure that will be a phenomenal interview. We definitely are going to be sticking with that. In the meantime, we're taking a look at gold, headed for its first weekly decline in more than 2 months. Question of whether this is the end of the momentum that we saw sending prices to the highest levels on record, or whether this is just a mere blip, a sort of recouping as we head toward new highs. Mike McClone joining us now, Bloomberg Intelligence, covering all things commodities. Mike, what's your take right now on the dip that we've seen in gold?
Hi, Lisa. Mere blip. It's way overdue. The market was just way overdue for correction, consolidation. And look at it right now. We're looking, it's 1950 an ounce. We're looking down upon the old highs. So that's not anything but a bull market that's consolidating. It could consolidate for a month or even a year, but this is a bull market with underpinnings for higher prices that I think are stronger than in the aftermath of the financial crisis. And from 2008 to 2011, gold increased about 3 times. So I think that's what we should look for gold in the next 3 years.
And just to give some perspective, gold is up about nearly 30% on the year so far. What's the main argument behind this bull rally that you see?
Well, we all know it's unprecedented quantitative easing from the major central banks on the planet, and it's not just the U.S., it's every one of them. Then you look at U.S. debt to GDP running almost 140%. I was just looking at the trajectory this morning. It's much higher than it was after the financial crisis, and where's the end in sight? I don't see it. So the key thing I'm also looking at right now is the stock market. If we have a potential rollover, if copper peaks here, which I'm afraid it will, that's just more fuel for more QE, and that's the key thing that's driving gold is QE.
Okay, is it basically the devaluation of fiat currency? Is that the issue, or is it a bet on inflation? What's sort of the larger concept here behind what QE is doing that makes gold so attractive?
Inflation's the dream, and at some point we'll get there, and at some point that's kind of the win-win for gold. Right now it's still purely deflation, and central banks need to keep priming the pump. And the key, I think, inflection point is if we get a double top in the stock market, that's going to just bring in more QE. So right now, it's only deflation, and gold's going to continue to advance that environment. Right now, it's just a little bit overbought. Problem is, you look at crude. I'm sorry, go ahead.
No, it's a little overbought. I mean, it just sort of raises a question here because there are a lot of investors that have been saying buy gold instead of bonds to offset equities as sort of a hedge against a risk-off kind of feel, and yet we've seen gold increasingly move in tandem with stocks. How do you make sense of that? I mean, is that just a short-term positioning issue, or is this a longer-term trend that stocks are responding to more QE and gold is responding to more QE, so these are going to move in tandem?
I agree for now, but the key thing you mentioned, bonds. Look at the 30-year long bond. There's only 140 basis points left till zero, and it's heading that way. Unless you expect yields to really start a new bull market in yields higher, which is unlikely, there's just not much lot upside in capital appreciation and price appreciation, but in gold's unlimited. So I view that as just expect the trends to continue, and particularly from certain levels. Like I view copper as getting really expensive around 3, it's backing off. Crude oil got a very expensive above like 42, it's backing off. And what if the stock market kind of turns over here? That just kicks in the next round of QE.
All right, so we covered gold. I do want to get your sense on oil because we did see a little bit of weakness, and we're seeing that continue today as we get warnings from the IEA, for example, that we're going to see much weaker demand going forward based on disappointing air travel. What is the main driver here? Is it the supply issues that were driving the market earlier this year with Saudi Arabia and Russia coming into a dispute about production, or is this really going to continue to be a demand story that is hampered by that lack of uptick in air travel?
It's all the above, and I think we've had the V bottom for now, but crude oil is in an extended bear market. There's just too much supply, lack of demand, and I think the market's too optimistic about demand coming back on. The IE report kind of put some reality into that. We're not going to just have demand come right back. And by the way, the old 50 is the new 40, meaning U.S. shale makers can start making money around 40 if they start producing, which they will. And as OPEC needs money, there's just supply's going to come back with any uptick in prices.
So in other words, you think that prices are going to remain range bound, or do you see them breaking out one way or another?
Down. I think WTI is much more likely to head towards 30 than sustain above anywhere near 50. And particularly, the key risk is if we get a rollover in the stock market. If stocks peak anywhere near here, crude oil should drop about double the velocity.
Well, what would you say to people who look at China and say you see industrial production coming back online? It's easier to bring industrial production back online than it is consumption, and that is the driver of demand from a lot of markets. Isn't this a positive for crude that helps to offset some of the decline in air travel?
It is. It should be, but China has really been export-driven and really depends on the rest of the world. And if you look at GDP in China, it's been declining for 10 years. And I mean, one thing I've learned about lately in China, anytime people get too optimistic about GDP estimates, drop your estimates and expect copper and crude oil to drop. So I think that's a trend that's been in place for a couple of years now, and I don't see why it should end. And actually, I think it's going to accelerate, i.e., people are overestimating the pickup from demand from China in crude oil and copper.
All right, Mike, before I let you go, I know you come from a family of farmers. I know you watch this space very closely heading into this weekend where we get a discussion of the trade agreement, the phase 1 trade agreement between the U.S. and China. Are you expecting anything material out of that that could affect all those soy farmers out in the Midwest?
No, they didn't help before. The thing about soy is soy demand is actually picking up versus supply. Soy looks good, but this year has been another bumper crop for corn, and that's going to be overhang for a while. So the market's just leveling at this lower plateau. The key thing that the grains need is a peak in the dollar. They need a weaker dollar so we can export now. Right now, this dollar's come off a little bit, but historically, it's still quite strong.
Mike McClone, thank you so much for taking the time. Mike McClone of Bloomberg Intelligence, out there taking a break from working in the office, swimming in a pool. We all feel terrible for you. Cannot wait to see you, I got to be honest, when you get back to the office. Meanwhile, let's take a look what's going on in the markets. A little bit of a support, really range-bound on the S&P. The NASDAQ, though, out in front and solidly to the upside, actually gaining ahead of the open. S&P still lower. 10-year yields coming down, breaking a 5-day rising streak, and the euro gaining a little bit versus the dollar, a little bit more volatility. You're definitely seeing a churn to markets here as people try to understand what the main driver is going to be in a world awash with liquidity. Still no deal, no prospect of a deal in Washington, D.C. at a time of growing tensions between the U.S. and China. That meeting starting tomorrow between trade representatives to discuss the phase 1 trade agreement. Yet a lot of people coming on this show this week saying, you know what, right now, the Fed printing money, all the central banks printing money, the government will come through with a fiscal support deal, and based on that, go with momentum. We'll see how long that lasts. Coming up, we're going to be hearing from Mohamed El-Arian speaking on Bloomberg The Open. Also speaking, it will be Joel Greenblatt at 10:30 a.m. New York time, Gotham Asset Management Co-Chief Investment Officer. This is Bloomberg Surveillance.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From New York City, for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures down 1/10%. We begin with the big issue. It's Groundhog Day on Capitol Hill. With the economic recovery decelerating, senators are going home. Roughly $1 trillion in state aid remaining the biggest stumbling block, and it's the same old story in the nation's capital. Senate Majority Leader Mitch McConnell placing blame on the Democrats.
Republicans have been at the table for weeks. We just need seriousness on the other side. Democrats must rerun their political calculations and finally let Congress act.
And guess what? House Speaker Nancy Pelosi snapping back.
Perhaps you mistook them for somebody who gave a damn. That isn't the case. So this is very far apart, and unless they see the reality of what it means in the lives of the American people, what good is it for us to agree to something that has no relationship to meeting the needs of the American people?
Well, if you're hoping for a whole lot more help, you might be hoping through the Labor Day holiday here in the United States. Joining us now on the economic data is Bloomberg's Michael McKee. Good morning to you, Mike.
Good morning to you, John. Well, we got retail sales today, and although they didn't match expectations, the general trend matches what we expected. Retail activity, the pace of it slowing in the month of July. Retail sales come in up 1.2%, ex-cars 1.9%. Car sales declined in this report. Unit sales were higher, so there are some questions about that. The control group, which is what economists like to watch because it's sort of a substitute for GDP. It's what goes into GDP from retail sales, up 1.4%, better than expected, down from what we saw in the month of June, which was a 6% rise. But here's the interesting thing, John. Retail sales are giving us a V shape so far. What we're seeing is sales up by 1.2% over where they were in January before the pandemic started, and the control group up more than 7% over where it was. So we have more than recovered retail sales in terms of total dollar value, and they're back or ahead of plan. The question is now, do we see that continue through the month of August now that the $600 in additional unemployment insurance has gone away? Another interesting thing today, we got numbers matching ours from China, and they're in the opposite situation. Their industrial production was higher, up by 4.8%. It's a little bit lower than anticipated, but it was up. But retail sales there down on the month. So China, which was held up as a model for us, growing a little bit more slowly than perhaps people thought.
Mike, just makes you wonder, how dependent are we on fiscal aid going deeper into summer, and how much of this recovery now is self-sustaining?
Well, that's going to be the question. Remember, we had that 18% gain in May in retail sales. That's when everybody got those $1,200 checks. Then we had a decent June and a little bit of slowing in July as the stimulus money started to run out. And we are going to be watching very closely to see what happens during August with that extra money gone and still 15 to 16 million people on the unemployment rolls.
Michael McKee on the economic data. Mike, we appreciate it. Thank you, sir. Looking at the equity market this morning, 27 minutes away from the opening bell. Equity futures just slightly negative. We're down 5 points on the S&P 500 and off a little more than 0.1%. Bloomberg opinion columnist Mohammed Al-Arian saying investors are alternating themes and positioning to keep the rally going, writing the following: as long as the confidence in ample liquidity is unshaken, investors will be tempted to buy the price dips influenced by perceptions of how well the economic and health emergencies are being managed. Mohammed joins us right now. Mohammed, great to catch up with you, sir. Your initial reaction to the data we had around about 33 minutes ago?
As expected, John, for the reasons Mike McKee just pointed out, we are slowing in terms of the recovery, and the components that are slowing the most are the ones that involve engaging outside. So the stay-at-home buying is continuing, but unfortunately, with what's been happening on the health side, we're seeing less involvement in the economy as a whole. So it is really consistent with the square root sign of what's going to go on, especially if we don't get actions from Congress on unemployment benefits.
Well, Mohammed, the month of August is going to be a really interesting month. The enhanced unemployment benefits ended in July, at the end of July. What are you expecting this month?
A significant slowing, unfortunately. What the data tells you is this is a very resilient economy. And so far, the consumer has been both willing and able to power us through what otherwise would look pretty dark. But part of that ability to power us through is through income support. So I'm worried that we are going to see a significant slowing in August, and depending on what happens in the next few weeks, even in September.
Mohammed, do you think we're making a satisfactory handoff away from fiscal help, fiscal aid, towards a self-sustaining recovery?
Not as yet, John. You know, we have three issues. One is the health emergency, and how well do we understand it, and how can we counter it? The other one are the changes in the economy. But the third one that we hardly ever talk about is behavioral issues. Informed people, are they aligning their risk assessments with what's consistent with society? Are they acting in a way that allows us all to live with COVID in a healthy and economically productive way? And that is proving to be a huge challenge, not just here, but increasingly around the world as well.
Well, let's talk about the rest of the world. I think two of the most important, interesting data points of this week so far came out of the UK. The UK economy contracted more than 20%. That's the one data point. The other is the unemployment rate of 3.9%. Mohammed, you can't reconcile the two things without understanding the fiscal help that has been offered to people who are still considered employed. And we face this really important decision now. We continue on with fiscal policy this way and carry on trying to help people who can't get a job, or we try and wean this economy off the stimulus. Mohammed, how difficult is this moment now for policymakers?
It is really, really hard. Everybody went into this, and I'm going to use game theory terminology, not because I think this is a game. This is really serious, but game theory terminology gives you really good insights. Everybody went into this thinking it was a one-round game. You get hit with the virus, you deal with it, you support everybody, and then we go back to normal. Now we're finding out it's a multi-round game, and multi-round strategies are very different from one-round strategies. And that is what the UK is discovering. This is really hard decisions. And remember, John, there are 4 things that government should be doing, not just relief, which is what we're talking about, but also making sure we can live better with COVID, also making sure that we take action to counter the increase in household economic insecurity, and also be careful of deglobalization, be careful of industrial concentration. All that is going on and is going to be a further headwind to growth over the long term. So this is really hard for governments, and they are struggling in the first bucket, let alone the next 3.
Mohammed, you said it's a multi-round game for policymakers. Is it a multi-round game for market participants?
John, so far, all that matters for participants is the following. Do I have confidence in the reliable and ample provision of liquidity by central banks. And as long as the marketplace says yes, you're going to go up higher and you're going to decouple more and more from economic realities. But I keep on telling people, favorable technicals are a necessary condition for you to do well, but they're not sufficient over the long term. You're going to need a handoff. And you see this week, the markets struggle with what theme am I pursuing underneath the liquidity theme? Am I pursuing the reopening theme as we did earlier this week? Or am I pursuing the stay-at-home theme as we did later in the week? They alternate between themes, but as long as there's confidence in the support of central banks, these market technicals can take us quite a long way until you get a big shock. And then we're going to find out if that happens, and I hope it doesn't happen, but if that happens, that we've overshot.
What I think you're hitting at is testing that confidence then, Mohammed. So build on that. What are you looking for that you think could test the confidence that people have in the policymaker?
So people expect central banks to do more. The whole narrative about the Fed, for example, is they're going to do more on forward guidance. They're going to do more on QE. So there's this notion that the central banks will continue to do more of the same, regardless of whether there's a handoff to fiscal or not. And it puts central banks in a lose-lose situation. If they don't do more, they can be responsible for a market sell-off that undermines the economic recovery. But if they do more, there's just exaggerating the decoupling. So this is a really tough environment, and people should always think a little bit about risk mitigation in this context.
Risk mitigation how, Mohammed? Because that's a conversation that's come up repeatedly in the last several weeks. How do you mitigate risks in this market, the best way of doing it?
So, as we've discussed before, and that has to do with what's been happening to gold, it has to do with what's been happening to investment grade, what even is starting to happen to high yield. People have realized that government bonds are not the risk mitigator they used to be, that the price risk is so asymmetrical that they have to do something more. And we've seen people migrate to a bucket of risk mitigators. And what's the irony in this, John, is the bucket of risk mitigator includes risk. So it's not just gold, it's the front end of investment grade, and some are even seeing the front end of high yield as being part of this risk mitigation bucket. And it tells you the extent to which markets have been distorted by the involvement of central banks. People now think that risky assets are risk-free in their portfolio.
Mohammed, before we let you go, I want to talk about the consensus. Coming out of the last crisis, the consensus believed that rates would go up in the next couple of years. Some people were really worried about inflation because of the unprecedented stimulus we were getting at the time from global central banks. Now the consensus is, conditioned by the past, that rates are going nowhere for a long time, including at the long end, not just the front end, and that disinflationary forces will be the dominant force through the next several years. Any reason to believe that won't be the case?
Well, first of all, it's really fascinating to see what's been happening to real rates. And apart from this week, which seen us go back to levels of nominal yields that we haven't seen for a couple of months, what really drove real yields down wasn't a collapse in inflation expectation, was the pressure that central banks put on nominal yields. So inflationary expectations have started to creep up, and the latest data is consistent with that. John, look, it's really hard because if you just look at the supply side, you would be worried about inflation. But it's the demand side that's making this consensus so strong. People simply don't see demand coming back in a huge way, and that's why that is. I think it's an open question. I think if you look beyond a year, it's an open question whether we get inflationary pressures or not. I just hope we don't get stagflation. That would be the worst of all world for markets and, of course, for households.
Mohammed, love catching up with you. And as always, early Friday morning on the West Coast. Thank the family for the disruption this morning. Mohammed, thank you. Coming up on this programme, our cracks emerging in the European recovery story. That conversation coming up next with Michael Purvis of Tallback and Capital Advisors from New York City this morning. Good morning. With equity futures down 4 points, you're watching Bloomberg TV.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
What we are already seeing in Europe is the consumer is responding very quickly to that. So we saw in July data consumer confidence in the euro area, or actually in large parts of the world, no longer improving, in some places even declining. If that is the labor market, or if that is the re-increase in the virus, that will potentially make us respond in our very own way and take our own precaution even without lockdowns. Both factors would suggest that there is a risk to the recovery, and that there is a risk that we are plateauing early.
Bank of America's Evelyn Herman on the story of the last month or so, the consensus view on programs like this. It's time to overweight Europe relative to the United States. I can tell you in the last couple of days, there are cracks in the bullishness. Joining us now is Bloomberg's Taylor Riggs. Good morning to you, Taylor.
Good morning, John. And part of what you heard there, the drop in employment, some of the concerns about the rising cases, means it's the travel stocks in particular that are getting the hardest hit this morning in London trading. Take a look at EasyJet, for example, off anywhere from 5 to 7.5%. Year to date, John, we are off 60% for some of these stocks. Flip up the board and take a look at this chart that I'm showing inside my terminal, because as you heard from Evelyn and Muhammad, so far it's been the consumer that's been holding up this economy. What happens if the consumer pulls back? Consumer confidence overall in blue there has been falling. Arguably, though, more importantly, in white, confidence in the future, that's even lower. So if investors and consumers are even less certain about the future, they are not going to spend. And what that means for the equity markets is you have started to see a little bit of that underperformance of Euro stocks relative to the S&P 500. It was so interesting, BlackRock earlier this month making the case that due to the weaker dollar, strong fiscal stimulus in Europe, that it really is appropriate to be overweighting European equities at this moment. But John, valuations, they're cheaper for a reason.
We've heard that so many times, haven't we? There's a valuation gap, and it keeps turning out to be a bit of a trap. I have no idea if it's different this time around. Taylor, great to catch up. Taylor Riggs there from the market desk on the latest in this market. As Taylor pointed out, around about 14 minutes away from the opening bell, equity futures down just 0.1% on the S&P 500. Just take a quick sneak peek of what's happening over in Europe. The FTSE down by 1.9%. The equity benchmark in Frankfurt, Germany, negative 1 percentage point this Friday. Talkbacker's Michael Purvis saying the Buy Europe story remains intact. He writes the following: the increasing COVID cases in Europe versus the decreasing number in the US does not mean the rotation into Europe is over. When diversifying away from big tech, I continue to recommend buying European equities over US value stocks. Michael joins us right now. Michael, you're being very specific here that if you're going to embrace cyclical names, embrace them in Europe and not here in the United States.
Yes, that's right, John. Look, I think there's a couple of things to consider here, as we sort ourselves through this, very unusual and, sort of extreme pandemic. Muhammad was just talking about the game theory dimensions and how this is sort of a multifaceted, multi-stage situation as opposed to, a one-off. And I think that's a very helpful way to sort of think about this crisis. The U.S. response from a health policy response, but also from a fiscal policy response, has been very heterogeneous, but also very reactive, right? And I think what's been happening in Europe, after years, after a decade of whether France was going to leave, whether Italy was going to leave, and all the political risk surrounding the Eurozone. With this pandemic, you've seen, really Europe becoming a much more cohesive entity than it arguably has been at any point in the past. A Euro optimist might say, Merkel hasn't wasted the crisis in that respect. And I think that's very important. The stimulus that I see coming together in Europe has been very strategic and sort of forward-looking, if you will, and more deliberate. And you're seeing that reflected in a wide range of asset prices across the Eurozone. But the U.S. situation, we're seeing this right now, you know, with Congress going on holiday for another 3 weeks, you know, without a phase 4 stimulus bill coming, which is needed, right, to help this thing keep going. It's a very reactive response by U.S. policymakers, you know, right now. So I think that helps sort of set the contrast. Now, with respect to equities, I'm very keen to point out that when I compare U.S. equities to European equities, I strip out big cap tech and the whole, you know, stay-at-home stocks that have been performing so well. I look at Europe as basically value equities, and I look at U.S. as value equities. So, you know, I look at the Russell Value Index, for example, relative to the SX5E when I'm doing those comparisons, because they're almost different asset classes. The big cap tech versus, you know, so much of the rest of the S&P 500.
Michael, there is a big difference, though, between repricing redenomination risk on the continent and repricing the recovery. Let's just imagine we had an agreement down in Washington, a fiscal deal, and everyone went home, and that money wouldn't be deployed until early 2021. That's basically what everyone's getting bulled up on in Europe. On the recovery side, the money that's been agreed won't be deployed until early next year. Now, I'm with you. On repricing redenomination risk, that makes a ton of sense because we have some cohesion on the fiscal side on the continent. But repricing the recovery, do you think we've taken that story too far?
Well, yes, but I think, you know, when we see the caseloads spiking in Germany and in Spain and in France, right? And we're seeing, you know, the week-over-week growth rates across the U.S. declining, you know, from 14% down to 6%, right? But what this just reminds us is how difficult and how nuanced health policy has to be. And I think you have to get back to this question, you know, when you're comparing the two, Europe versus the U.S., that the virus is persistent and it's resilient and it's kind of devastating in so many ways. So the question is where would you rather, which set of policymakers are going to be more able to re-tackle this virus? If Germany's dealing with a second wave and we're just coming through our rolling first wave, well, who's to say we won't get a second wave, you know, in the U.S. that will be really, really bad? And I keep coming back to this notion that the systems in place in Europe, obviously Spain and Italy made some big mistakes earlier in the year, but they seem to have the ability to aggressively implement, you know, health policies, whereas the U.S. response has been extraordinarily, you know, sort of a patchwork, if you will. And I think, you know, probably what's needed is something that's much more aggressive and top down, where they can kind of freeze it down. So I think the virus risk applies to every country on the planet. And I think the question is whether the policymakers are going to be more able to manage that. So yes, I agree that I think that the markets have kind of got complacent with respect to how persistent this virus is going to be, and what the European data is reminding us of that persistence. But the question is who's better, you know, which economies are better able to manage that? And I would say certainly right now that seems to be Europe.
Michael, great to catch up. As always, my best to you and yours. Michael Purvis there of Tallback. And coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And later, Bank of America's Savita Subramaniam joining us on the value versus growth debate with an equity market struggling to get back through all-time highs, just short of it over the last several days. From New York City this morning, good morning, with equity futures down 3, we're negative 0.1%. You're watching Bloomberg TV. Looking good for a third week of gains here on the S&P 500 coming into Friday. Equity futures down, but only by 3-4 points on the S&P 500. We're down 1/10%. Let's get you some morning calls, shall we? A look at some of the analyst recommendations on Wall Street this morning. First up, the team at Barclays cutting its price target on Micron down to 55, maintaining its overweight rating. The analyst citing near-term headwinds after the chip maker indicated weaker demand for the month of August. We are down by almost 1% in early trading. Jefferies upgrading Hilton Worldwide to a buy, a 72 price target. The analyst expecting investors to start seeking high-quality laggards as the economy recovers. We inch higher there by 0.2%. And your third and final call from Bank of America and Morgan Stanley, both upgrading Tesla since Thursday's closing bell. Adam Jonas of Morgan Stanley boosting shares to equal weight with a 1060 price target, citing the potential for a build-out of the group's battery business. That stock up by another 2.4%. Coming up on this program, Bank of America's Savita Subramanian with an equity market getting very close to record highs.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Just bumping up against all-time highs on the S&P 500. Equity futures pulling back. We are down by 5 points. We are negative a little more than 1/10%. No drama. Back on top to end the week. At the bottom at the start of the week, on top to end it, Nasdaq futures up 15. We advance 1/10%. There's your opening bow this Friday morning. Switch up the board. 5-day losing streak for Treasuries coming into Friday. We erased just a little bit this Friday morning. Yields come in 2 basis points. Just about 70 basis points is your yield on the US 10-year. Slap bang in the middle of the post-COVID trading range on a 10-year yield between 50 and 90 basis points. We trade at 70. In the FX market, the euro just slightly firmer. Euro dollar 118.25. Had a sneak peek of 119. Took a visit in the last couple of weeks. Didn't like what it saw, apparently, back down to 118. And in the commodity market, to round things out, 0.6% lower on the WTI price. Crude, $42 a barrel. That's the story. Cross-asset. Let's get to the market desk and get you some movers. Here's Abigail.
John, let's start out with one stock that is soaring, and that is Dillard's Department Store. The company really put up a very strong, surprisingly strong second quarter, a much smaller loss than expected, a loss of 37 cents versus the estimate of a loss of $4.82. All of this despite the pandemic difficulties. Now, they also cut their inventory by 20%. Telsey is calling this quarter a wind in the sales, and you can see that investors certainly liking it. Applied Materials also popping higher, up 4% at this point. They raised their outlook as orders have rebounded, and of course they are a cap equipment company, so this has positive macro implications from the standpoint of potential demand from chip makers and technology companies and other companies that use those chips. Baidu, though, not so much, down 5.2%. They're falling on two factors. First, the outlook, and then also the investigation into their Netflix-type unit. The revenue guidance for China's largest search company was 4% below estimates. Investors not liking that. Plus, they're saying that for that Netflix-type unit, that they inflated users in the U.S. Alibaba, however, is popping up just a bit, 0.5%, as they're added to the Hang Seng. As for earnings out of companies that recently, relatively recently, over the last year, couple of years, IPO'd, we have a mixed bag here. Purple Innovations, the mattress company, they missed the lowest revenue estimate, but the street is saying buy this weakness. Lots of price targets raised out there, including over at KeyBank. DraftKings, a disappointing quarter. They beat revenue estimates, but missed earnings. It looks like sports leagues returning helped toward the end of the quarter, but not enough to help earnings, profits. And then finally, Rocket Company, the mortgage company, pre-announced the upside net revenue up 437% year over year, loan origination up 126% year over year. It seems that this trend toward buying houses in the U.S. in the wake of the pandemic is really taking hold and certainly helping Rocket Company this morning, John.
One of the bright spots in this economy. Abigail, thank you. 2 minutes and about 30 seconds into the session. Equities down 0.2%. Energy, bottom of the pile. Big tech, near the top of the pile in today's session. Value laggards struggling to hold their brief leadership over growth at the start of the week. It tailed off towards the end of the week. BTIG's Julian Emmanuel expecting cyclicals to lead the next leg of the rotation.
For a number of weeks now, we've had the momentum trade start to slow. Behind the scenes, the NASDAQ has lost momentum, as that rotation, which we actually believe will continue into cyclicals, into value, into international markets.
Back with us, Taylor Riggs. Hey, Taylor.
John, every day we wake up, we think value's going to have its day, right? Yesterday we thought the same thing, but then late in the session, in the final 2 hours of trading, that unravels and growth really starts to pick up that outperformance. You're seeing that really just again this morning, where growth has been some of the big outperformers here relative to value, which has been one of the underperformers. Of course, smaller caps leading the declines on the value side this morning. Flip of the board, let's take a look at this terminal chart here, because we've really started to see this trend, as we heard from Julian Emmanuel. Value start to gain traction. Of course, you have 10-year yields up 15 basis points this week, and so value looked attractive, but the trend, it unwinds, particularly as you were saying towards the end of the week, with then growth, of course, rearing its ugly head and being the big outperformer. What this means, though, for performance, John, is you've seen this divergence before, where you start to see this trend, but inevitably growth always becomes the big outperformer here. Right now, there's now a $14 trillion gap between the two leaders, that's tech and healthcare, and then the 5 laggards. You're talking energy, you're talking industrials, you're talking financials. So if you want to see a rotation, it's going to have to be a pretty big rotation at that, John.
Taylor Riggs, thank you. Taylor, stay close. We need to catch up with you a little bit later on the bond supply we've had so far this week. Savita Subramanian of Bank of America weighing in on one dilemma facing many investors, writing the following: the decision between stocks and bonds is a no-brainer. Buy stocks, a blend of quality and value. Buy value and old tech. Avoid value traps. Savita makes it sound easy. She knows it's not. She joins us now. Savita, fantastic to catch up with you. Just walk me through your thinking at the moment, please.
Yeah, so I think, this whole cyclical value rotation, we've all, been smacked down repeatedly by calling for that. So I think at this point, it's going to be a nuanced value rotation. And here's the trick. So the traps are the buggy whips. And when you think about it, buggy whips got cheaper and cheaper and cheaper and then went to zero. And I think what's happening right now is some value is in the process of being slowly disrupted, essentially disintermediated by technology and by growth stocks. So if you look at within financials, there's fintech versus traditional tech or traditional financials. If you look within, retail, it's online versus brick and mortar. So I think the trick is to avoid the buggy whips or the traps and look for quality and value. And I think there's a lot of quality value plays right now, especially within the industrial sector. So, let's just look at why value should work at this point. So one of the things that we found is that in 14 out of 14 of the last recessions, value outperformed growth for at least a 3-month period. So there's a very good argument for having more of a value bias right now. But again, I think you need to pick your spots and look for the companies that are real quality, are just beaten down because we're exiting one of the worst recessions in the in history, and are likely to benefit from a pickup in the economy.
Savita, I hate to reduce your extensive research just down to one price target, but your price target does stand out at 2,900. You and I have been talking about this. Can you just walk us through why 2,900, with everything around you just sort of capitulating and the equity market getting back to all-time highs?
Yeah, no, it's a good question. So I think, when we look at our price target, it's a process and it's a blend of a bunch of different signals. The most bullish signal right now is sentiment and positioning, because, sentiment, as we've talked about on this program, we've never seen this bull market really wholeheartedly loved. We haven't gotten to that investor euphoria on stocks that typically heralds the end of a real bull market. But on the flip side, if you look at a fair value approach, it's really hard to get, to the levels that we're at right now using the textbook kind of fair value approach where you try to figure out normalized earnings and the appropriate cost of capital. So, I think that where we are right now is a market that's being fueled by liquidity, by, no other options. As you said, there's no better place to be than stocks from an income perspective. But the fair value of the market would actually pull it down to 2,500 by our life.
Wow.
So that blend of signals, it's hard to get a fair value model to clear the levels we're at without having very, very aggressive cost of equity capital assumptions. This is all theory, and in practice, what's driving the market is massive liquidity, fiscal, Fed, corporate, you name it, we've got it. So I think that that's the disconnect right now. What I worry about is when this liquidity spigot starts to turn off, that's when the rubber meets the road and you really start to see fundamentals mattering much more than just the technicals.
If the liquidity wears off, Savita, and at the moment that's a big question. Someone wrote in just as you and I were about to start this conversation, and they want to know how rare it is to have an equity market on the brink of going through a record high and to have the VIX in the 20s. Savita, how rare is that?
Yeah, it's pretty unusual. So this has been a very unusual bull market. We've had a bull market where high beta stocks have lagged. We've had a bull market where defensive, high dividend yields, and, kind of secular growth has led. This is a very weird bull market. It's not your typical bull market. And I think the reason is that it's not against the backdrop of an improving economic cycle. It's against the backdrop of just massive liquidity. That's really all you need to track is liquidity.
Savita, I always enjoy catching up with you. This morning, no different. Always great to catch up. Savita Subramaniam there of Bank of America. In this market right now, 9 minutes into the session, equities down a little more than 0.1%. The Nasdaq firmer by a similar amount. Just turn that one on its head. Let's get to the market desk, shall we? Get you some movers. Here's Abigail.
John, another day, and we have another biotech company once again soaring on vaccine news. This is Novavax, of course, and that stock is really popping sharply higher. And the news that the UK has expanded their COVID vaccine deal. They're buying 60 million doses. And they will also help the company with the phase 3 clinical trial. The stock's actually off of its highs, still up 4% on the year, though. It's incredible, up more than 3,400%. Farfetch, the online clothing company, is soaring in a big way at its best level in about 2 years. They put up a really big quarter, revenues rising 74%. Online traffic up 605%, not surprisingly. Another bright spot here from the pandemic with people at home and shut down to some degree. Now, Fannie Mae and Freddie Mac, the government-backed companies that buy mortgages from lenders, package them into securities, and then sell to investors to provide liquidity for the market. They're about flat now. In the pre-market, both had been down about 6%. This on the news that the company is going to be raising borrower costs, adding a 0.5% fee. This will amount to about $1,400 per borrower. The fear is that it could slow growth, and the White House has criticized this plan, especially saying that it is the opposite of what the Federal Reserve is doing relative to liquidity. Right now, though, those investors not seeming to care all that much, John.
Abigail, thank you very much. We'll touch base with Abigail a little bit later this hour on the sector price action. Coming up on this program, we have had record supply from the Treasury. We have had record supply from corporate America as well. In the credit market, in the bond market, are we starting to see some signs of indigestion? Up next, Jim Bianco of Bianco Research from New York City this morning. Good morning. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
It's such an interesting new world.
The world is changing. For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging. We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
This is what a summer Friday feels like at the equity market stateside. The S&P 500 negative 0.1%, the Nasdaq going nowhere. If you're looking for some price action, just look at the weakness in Europe. The equity-based March in Frankfurt, Germany, the DAX down by 0.8%. The equity benchmark in Frankfurt not looking good. On the FTSE, we are down by 1.69%. That's the story of the equity market. Let's get to the story of the bond market. Record supply from the Treasury. We had issues, 3, 10s and 30s. 3s went well, 10s went okay. Then the 30-year auction absolutely flopped. For more, let's bring in Taylor Riggs, shall we? Hey, Taylor.
John, you may call it a summer Friday within the equity markets. It is not a summer Friday within these bond markets. You mentioned the weak 30-year bond auction yesterday. As you'll see, it was one of the worst bid-to-cover ratios that we have seen in a year. The auction was offered at $26 billion. That is $7 billion more than July, or up 7%. So you're talking about rising supply really starting to shake up the market. 3s, 10s, 30s, all looking at higher supply in August than we had in July. What that means, flip up the board, let's take a look at this chart in the terminal. Yields are rising in anticipation of that supply. 10-year yields are up 14 basis points alone this week. That is the biggest jump going back in 2 months. And yes, I'm hearing higher inflation expectations, some improvement in the growth market, but really, this is a technical issue like, yes, rising supply within the markets. Finally, let's just take a look at the forward look on this calendar, John, because it doesn't look like that supply is easing. You have $1 trillion more of stimulus to pay for. So, of course, we are adding to our borrowing expectations. August 3rd, Treasury announced that they're adding $1 trillion more than they thought in May, $2 trillion in borrowing for the rest of the year. I know we don't really care about deficits anymore, John, but I'm wondering if the market's starting to wake up and notice and adjust those yields appropriately.
Just a little bit of indigestion this week. Taylor Riggs, thank you. Catch Taylor at the closing bell on Bloomberg TV a little bit later. Jim Bianco of Bianco Research weighing in on the supply concerns, saying the following. The Fed's massive purchases of bonds over the last 5 months is actually shrinking the size of the bond market available to the private sector, keeping bond market volatility near all-time lows and long-term yields trending sideways. What upsets this dynamic is the Fed exiting or a return of inflation. Jim Bianco joins us right now. Jim, great to catch up. Let's talk about it. Are we seeing some fatigue, some indigestion in this bond market?
Yeah, I think we are beginning to see it. As the quote you started with, it's amazing to think that the Bloomberg Barclays Aggregate Index, which is the benchmark for the bond market, is about $1 trillion smaller than it started the year, even though we've got all this massive issuance and this huge budget deficit. And the reason is the Fed has bought more than has actually been issued, which has caused the market to shrink. Well, all this issuance is starting to catch up now. And as we move forward, the Fed has kind of found a glide path at a much lower purchase level, but the issuance is not going to stop, especially at the government level. So we're going to start to see supply now start to become the issue. And that's why I think the beginning we're seeing indigestion, especially out at the 30-year sector, which is where the Fed is the least active of all of the maturity buckets where they could be.
So, Jim, that last piece that you mentioned, I think is probably the most important piece. We've been talking about this, you and I, for the last several months. Every pocket, every corner of fixed income is distorted. Where's the clear signal? Is the clearest signal, relatively speaking, the very long end of the Treasury curve?
It could be, because that's where you've got the least amount of activity. But you're right. I mean, it's important to understand, whenever you talk about the fixed income market, especially in the United States, the largest player is an insensitive price buyer in the central bank, whether it's in corporate bonds, it's in short-term securities through QE, whether it's in now even in municipal securities. But so where are they not playing as much? Out at around the 30-year sector as well. And there, when you start to see rates start to head higher and you start to see volatility kick up, that might be the one place you could find a signal for this bond market.
So, Jim, let's build on this. The purest play for the underlying economy in the market right now, where do you think it is?
Oh, for the whole underlying economy, the purest play, that's a tough one to play, because I think it's probably going to be somewhere away from the financial sector altogether. Something like gold would be a play where you start to see rising prices there. Gold is not necessarily indicating inflation, but it is indicating concern about the financial system or financial risk, to maybe say it better, and that's where I think you've seen the prices go up. But if you're looking at where you want to look in stocks, or if you want to look in the bond market, it gets a little tougher because of all of those distorting signals, because of those price-insensitive buyers.
That's the challenge for many people at the moment, Jim. How to reconcile their macro view with their market view. And as you sit there struggling to reconcile the two things, you'll start to make mistakes, because quite often you can't reconcile the macro view with the market view. And that's not new post-COVID. That was a story that persisted for several years going into this crisis as well. And I just wonder, Jim, how difficult it is to avoid getting married to your macro view and allowing that to shape almost exclusively how you express your views in markets at the moment.
You know, when you ask the question, I'm thinking, yeah, it is very difficult. And if you want to know a real-time example of how difficult that may look, to Washington. There's no doubt that the economy stalled in mid-June and that it has been struggling to advance. Maybe it's not W-downing again, but it's certainly not moving forward. And yet we can't get a deal together. And one of the reasons I've even postulated on things like Twitter, too, that we can't get a deal as the stock market's at an all-time high, and congressmen look at it and say, hey, there's no problem. The stock market's at a high. If we were to ever get a 10 or 20% correction, we'd probably have a deal in 5 minutes.
Yeah.
But we don't have that now. So when you talk about, looking at your macro view and trying to square it with everything else, look no further than Washington's inability to get a deal and probably the influence that a new all-time high in the stock market through all of these distortions is having in making them have an inability to get a deal.
What do you think breaks first, Jim? The market rally, the resiliency that we're seeing in equities through much of the last couple of weeks, even though Washington and talks have gone nowhere, or the resolve down in D.C.? What breaks first, the D.C. resolve or the equity resistance?
Oh, I'd have to say, at least at this point, the D.C. resolve will be a reaction to something else. They're going to need to be forced into believing that inaction is bad for them. Right now, both sides think inaction is good for them. So either it would have to be a market break or it would have to be an economy break as well, too. Like if we were to see some of the data with initial claims or some of the weekly or high-frequency retail sales numbers take a serious dive down now that all those transfer payments are slowing down and not coming through. But I don't think they're going to come to it on their own in Washington and decide, no, now we need to have a deal as well. There's also October 1st is a debt ceiling limit, and that might be a point to push them. But boy, that's 6 weeks away, and that's a lifetime away, especially when you're in a presidential election season.
Jim, do you think we can push it that far? Just to wait until the middle, towards the end of September?
No, I don't think we can. There's going to be a lot of things that are going to happen between now and then. If we're just waiting for, that limit to come in to force them to have that deal, we're probably going to have to talk about whether or not there's going to be a second wave on the infection, and we're going to have a lot of people starting to focus on the election itself as well, too. The economy, we're going to get a lot more data on, and so maybe all of those things could really push us into seeing something happen one way or the other.
Hey, Jim, brilliant to catch up, as always. Enjoy the weekend, sir, won't you? Jim Bianco there of Bianco Research. In this equity market right now, 22 minutes into the session, equities down 0.25% on the S&P 500, down 1/3 on the NASDAQ with your sector price action. Here's Abigail.
John, beneath the surface, lifting the lid a little bit sector-wise, not a lot happening on this so far quiet Friday, summer Friday. If we go into the Bloomberg terminal and use the iMap, I'll show you what I'm talking about. It looks risk off on first glance because 10 of the 11 sectors are lower, but the biggest move to the downside is down by 0.4%, so not a big move, and that's consumer discretionary, one of this year's defensive sectors. On top, real estate up just ever so slightly, so a real hodgepodge there. The bigger question on the week, we do have all the major averages higher on the week, the S&P 500 and the NASDAQ just slightly, the Dow up more than 1%, the Dow transports up nearly 3%. That is suggesting that on the week it's more of a cyclical tilt, even though it's been feeling more techy recently. If we take a look at the 5-day board and the winners, we are going to see industrials, the top sector, up 2.5%, followed by discretionary. So that's the sector that's down today, really being helped out by Amazon on the week. And then materials and energy. So right now, this week, John, and similar to the month of August, it's sort of a stealth cyclical rally, but it's still in play.
Abigail Doolittle on the price action. Thank you. 23 minutes into the session, equities declining just a little bit on the S&P 500. Up next on the program, the events you need to be watching going into the weekend and coming out next week with US-China talks very much in focus. From New York City this morning, good morning. With your equity market declining just a little bit, this is Bloomberg.
investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Coming out the other side of the opening bell, 25 minutes into the session, call it 26. We're down just 0.1% on the S&P 500. No drama, down 0.2 on the Nasdaq. In Germany, in Frankfurt, Germany, down 0.9%. The weakness this morning in Europe. Coming up in your trading diary, as follows. Ton of Fed speak. Dallas Fed President Robert Kaplan speaking. We get University of Michigan sentiment survey. President Donald Trump delivering remarks from New Jersey at 5 Eastern. The US and China reviewing terms of their Phase 1 trade deal over the weekend, and then kicking off things on Monday, the Democratic National Convention. Ton of data through the week. Looking forward to covering with you right here on Bloomberg TV. From New York City for our audience worldwide, this was the countdown to the open. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication?
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. Because I think of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
So there's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949, in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there, not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, capital say,
24
people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比我们早。但是玩信息玩软的，中国人的脑袋绝不比我们差。我们在座的所有人的脑袋绝不比我们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, ValueAg, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch. Some people come with an Adobe Illustrator file. And we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I've learned so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is open, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it. And we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. bring it over to the aging table, where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
It's a bit like an addiction. You've got to make something. You have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Sven Cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice. You've got to be able to judge material temperatures. You've got to just look at it and you just get a feel for it. It's a stage where your tubes start to look a bit like a bicycle. My father's a jeweler. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create.
Okay, ladies and gentlemen, I'm placing stop on profit for Japanese yen. The stop we will place at 106.545. 106.545. The stop placed on a position we have at 106.575. Okay, so it will give us 300 pounds in profit if it will reach this level.
Outside part of the board using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There's a lot of time that goes into these boards, between 40 and 60 hours, start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, it's time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang